Hey, good morning. Welcome to the Mortgage Rate Forecast with Scott Criss, your mortgage rates and news. So it's June 15th, and let's get started with the charts. Now, you guys probably heard on the news yesterday that the Fed increased the short-term rate. The short-term rate is, of course, the rate that impacts the prime rate, which impacts your credit cards. If you have a second mortgage that adjusts, it usually adjusts to the prime rate, a home equity line of credit. And so we did see interest rates go up 1/4% yesterday, but did it impact the bond market? That's the question. And yes and no. Does that mean your 30-year fixed mortgage is going up 1/4% today compared to yesterday? No, no. Because there's a difference between long-term rates and short-term rates. So I apologize if you're a subscriber and you went through the last Fed rate hike. This is probably redundant. If you're a new subscriber, I hope you don't mind me explaining this to you. But the first distinction you have to understand is there's a difference between the short-term rate and the long-term rate, okay? Like a 30-year fixed mortgage and a short-term rate, which impacts your credit cards or things that adjust on a monthly basis. So how did the Fed impact us? Well, the bond market, as we talked about last Thursday, was kind of selling off, getting worse. And then with the poor news, the poor reports, economic reports that came out yesterday, bond market actually traded pretty well. Fed came out, they increased the short-term rate. Well, guess what? Bond investors were already estimating on this. We call it being baked in. So that being said, the bond market actually did pretty well yesterday. It was a little volatile, but that's going to happen based on what the Fed says, their outlook on the economy. And so, but today we opened low. You know what? Did our opening low today really have a direct impact on the Fed yesterday? No, guys. No, it was already baked in. So here's where we're at. We are finding support coming in below us at about 103. Next line of support is about 102.80. And then our resistance is still up here at 103.40, which we actually temporarily broke through yesterday. So nonetheless, here's where we're at. Reports came out today. Jobless claims, better than expected. Not good for bonds. Okay. Empire Manufacturing, better than expected. Not good for bonds. Philly Fed, same thing. Industrial production, neutral. No impact. Capacity utilization, no impact. So the thing is, the bond market, really, it's down a little bit today. Nothing too crazy compared to yesterday. But did interest rates go up 1/4% yesterday, guys, for 30-year fixed mortgages? No, right? Okay, that's what I wanted you to get. Now, what's our outlook? What's our outlook? So let me get into the rest. The Fed yesterday, we talked about that. So let's kind of quantify where things are at. Freddie Mac reported the average interest rate a consumer received in May was 4.01% and paid a half point to get there. That's with average bond trading about 102.85. So we're about 24 cents better than that. So the average consumer may be seeing something a little bit better on the points side. Okay, any sources down below? Look at Freddie Mac. That's average rates based on month. But let's get into the forecast. Now this gets really interesting, guys. My last projection was a hit. The projection before that was a slight miss by a few cents. I think it was 8 or 9 cents. So what's going on with the analysts? So they're kind of inconsistent right now. One of the analysts I track, he's pretty bearish. He thinks the bond market's going to sell off. The other analyst is pretty neutral. Pretty consistent with the analyst personality types. But here's what I'm going to say, at least on long. I think the long is going to do well. When the Fed increases a short-term rate, especially after seeing those reports that came out yesterday, the Fed's increasing the short-term rate to fight inflation, okay? And inflation is one of the bond's biggest enemies. So I think the Fed made a pretty gutsy move yesterday, given the reports that actually came out earlier in the day. And what I've seen in my history of tracking bonds, I usually see interest rates. It could take 3 months, but recently it's been as little as a month and a half before that increased rate really impacts the economy and we start to see economic slowdown, which is good for inflation. That's good for bonds. Okay, so I don't think the Fed's going to increase the short-term rate through the rest of the year. That's my projection at this point. I know we're only in June. But I think we could see some lower interest rates, but it's probably going to take a month and a half to 3 months for it to really impact the economy. So where the analyst bias is going to be more bearish and neutral, I'm going to go a little off of that. I'm going to go neutral to bullish. And so my forecast, and if I'm wrong, I apologize. I'm not trying to be overly aggressive. It's logic. Logic is telling me to go here. And I believe bonds are going to probably trade between 103 and 103.40. That's going to be room for about a 31 basis points gain from where we're at today, guys, or only a 9 basis point loss if I'm correct. And so I think between now and next Thursday, we may dip below for a little bit, but I think next Thursday I think we're going to stay above 103. So you can slap my hand if I'm wrong. You're more than welcome to. But and I'm not trying to be like really aggressive. That's not who I am. But looking at all the factors, we'll see what the economy brings and what the reports are next week. But I think we're going to go stable, if not maybe improve a little bit. So I'm going a little bit against analysts right now, guys. So that's it for now. Hey, we'd love to hear from you. What do you think? Leave those comments below. Hit that like button. I know you get tired of hearing that, but man, it helps. It helps. And if you want to subscribe to the channel, top left, just a little alert when we release new video. And top right, click on that baby. That's Mortgage Bonds 101. Mortgage Bonds 101. If none of this made sense to you, those charts and blah, 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 this stuff coming out of my mouth, that's a really great link to just give you the basics that you need to know to understand the bond market and how it impacts you as a consumer trying to get a mortgage. That's it for now, guys. We'll see you next Thursday. Have a great weekend. Bye-bye.